In a market flooded with sky-high valuations, finding real investment opportunities is getting harder by the day. It feels like everything is either overpriced or purely speculative. But this July I found 3 stocks that genuinely stand out. Not because they're trending on social media, but because they have real momentum, strong fundamentals, and clear catalysts for growth. These aren't risky bets or deep value traps. They're smart, well-positioned businesses for investors who want to stay rational, avoid the noise, and still capture meaningful upside. Make sure you stick till the end because the last one is probably my favorite of the 3 this month. Now, let's dive into my top 3 picks for July. Stock number 1 is Alphabet, more commonly known as Google. Alphabet's stock has cooled off in the recent months, dropping from its February highs. And while some investors are focusing on short-term concerns, I see a fundamentally strong business that is simply trading at a more reasonable price. Search, YouTube, Google Cloud are all growing, and the company is still a cash-generating machine. Now let me show you exactly why I like this company by breaking down its financials. So, Google is currently trading at around $177, down from its February high of over $200. The company is trading at just below 20 PE, and they have a great return on invested capital of almost 32. But one of the things that I like most about the company is their debt. As you can see, their net debt for the last 12 months is negative $66 billion, basically saying that they have more cash on hand than debt. They have this amazing revenue chart where they did $29 billion in 2010, and last year they did $350 billion. For net income, over the same period of time, they grew from $8.5 billion to $100. You got to love this growth. Looking at their shares outstanding, we can clearly see that they were issuing shares until 2018. But for the last 6 years, they have been buying back shares, which I love because they're increasing my share of the company along the way. And analysts predict their revenue to grow around 10% annually for the next 5 years. So all in all, Google's financials are rock solid. No debt, high return on invested capital, and very stable growth. They're also consistently buying back shares and are currently trading at a PE ratio below 20, which hasn't happened in a while. Honestly, no red flags. Now, let me calculate its intrinsic value and show you why I think it's undervalued today. So this is my intrinsic value calculator. Let's start by adding in the EPS Google did last year, which was $8.04. For the next 5-year growth, let's assume that analysts are correct and let's give them 10. And let's say they slow down and only do 8 for the 5 years after that. In my opinion, Google is a moat, so it deserves a higher terminal multiple than 15. So let's give it a 20. Now let's increase the expected rate of return as we see the company is currently undervalued. I gave it a 12.5, and now it seems that the price you should pay is really close to the actual price. Based on my assumptions, I believe Google is positioned to deliver 12.5% annualized return for the next decade. And that is exactly why it's one of my 3 picks for July. Alphabet is a high-quality stock trading at a fair price, and one that could outperform the market over the long run. Now, let's move on to the second pick. My second stock pick is Target, and it has been crushed, down more than 60% since its peak. And while the headlines have been brutal, I think the market may have overreacted. This isn't a dying business. It's a retail heavyweight going through a rough patch with real potential for a comeback. Now let's go to Target's financials so I can show you why I like the company. Target is currently trading at around $98, and it's far off its all-time highs from 2021 when it reached over $250. Target is trading at a really low, almost 11 PE ratio, and their return on invested capital is over 16, which is really great for a retail company. Same goes for their debt. Their net debt to EBITDA ratio is 1.7, and we like when companies are trading under 2.5, so Target clearly hits the mark, which is really rare when it comes to retail businesses because we have a lot of leases. Looking at their revenue, we see a slowdown over the past 2 years. But 2 years is not that long, so looking at the bigger picture, we can still see the company is growing. Net income is in a similar position. In 2017, they did $2.7 billion, whereas last year they did $4 billion. Now here's what I really like about the company. They have been buying back shares consistently. In 2017, they had 580 million shares, and last quarter they reported only 460, which means that in those 9 years, they increased your share of the company by 20% just by buying back shares, which is really nice to see, especially when the company is undervalued. Now let's see what analysts are predicting for the company. It seems like analyst predictions are fairly low, not growing over the next 2 years, and low single-digit growth over the next 4. Target's financials are solid, especially for a retailer. The company has low debt, trades at very low valuation multiples, and still manages a strong 16% return on invested capital. Additionally, they're buying back shares fairly heavily, which you love to see for an undervalued company. And its growth is holding up decently given the macro pressures. Now let's go to the intrinsic value calculator so I can show you why I believe the company is currently undervalued. Target's EPS for the last 12 months was $8.86. Now, let's say the company will struggle for the next 5 years and not grow at all. And for the 5 years after that, they will only grow at 3% annually. And let's give them a terminal multiple of the standard 15. With these assumptions for an annual return of 12.5%, it seems like the company should be trading at a really close valuation to what it is actually trading at right now. But if we would adjust the expected return to 12, all of a sudden the price is right. So even with 0% profit growth for the next 5 years and just 3% for the 5 years after that, if the valuation multiple would normalize to around 15, Target could still return around 12% annually over the next decade. That's why I believe Target is a classic value play. Beaten down, but far from broken. Now, before we wrap up with my third and final pick for July, which is probably my favorite one, I'd really appreciate if you could support the channel by smashing the like and subscribe buttons. And not because the algorithm cares, it's because I care. I care deeply. Maybe too deeply. So all jokes aside, the third and final pick is Uber. Uber isn't just a ride-handling app anymore. It's turning into a cash-generating platform with serious global scale. And even though many investors still see it as risky, I think the market is missing the bigger picture. Now let's jump into the financials so I can show you why. Uber is currently trading at around $93. And even though the stock is up around 50% over the last 6 months, that doesn't mean you have missed the boat. The company is currently trading at around 16 PE ratio with a decent return on invested capital of around 11. Also, the company has pretty much no debt. Just look at their net debt to EBITDA ratio. It's 0.01. Now just look at this revenue growth. In the last 10 years, they managed to grow their revenue from $3.8 billion to around $44 billion last year. And looking at their net income, it seems like we are finally turning to profitability, and we had their most profitable year in 2024, where they earned almost $10 billion. Now this is a thing I'm not that fond of, as they are issuing shares fairly consistently. However, over the past few years, the dilution has slowed down. And it seems like for growth, analysts predict mid-double digits to high single digits growth over the next 5 years. Uber's financials are stronger than you might expect. The company has virtually no debt, solid revenue and net income growth, and trades at fairly low valuation multiples. The only real red flag I see is their ongoing share dilution. It's not at critical levels, but I'd still like to see them stop issuing shares. Now let's do the intrinsic value calculation, and let me show you exactly why this is my favorite stock of the three. Uber did $5.71 in EPS over the last 12 months. For growth, let's give them 10% annualized return for the next decade. I know analysts predicted the growth to be higher for the next 5 years, but I think it will slow down for the 5 years after that, so let's just keep it all at 10. Let's keep the terminal multiple at 15, and maybe let's adjust the expected return to 15 to see if it's still green. And as you can see, it still is. So even with just 10% annual growth over the next decade, Uber is still positioned to deliver over 15% annual returns. And that's with using a conservative terminal multiple of 15. In my opinion, it's fairly low given the company's growth profile. But since I didn't factor in the ongoing share dilution, that helps to balance things out. Bottom line, Uber might still be misunderstood by the market, but the numbers tell a very different story. So to recap, we looked at 3 companies I think are well positioned heading into the future. A tech giant with strong fundamentals trading at a surprisingly fair valuation, a beaten down retailer that might be quietly setting up for a comeback, and a misunderstood platform business with real momentum and long-term upside. None of these are hype plays. They are not moonshot bets. They're companies with strong fundamentals, solid financials, and reasonable valuations. The kind of picks that do not just survive the market cycles, but compound over time. Of course, nothing is guaranteed, and you should not trust my picks blindly. Do your own due diligence. But if you're investing with logic and not emotion, and you're looking for opportunities the market might be underestimating, I think these 3 stocks are worth a closer look. Let me know in the comments which one you found the most interesting. Or is there any other stock you think should have made the list? If you enjoyed the video, consider clicking the like and subscribe buttons to help grow my channel. And as always, guys, thank you for watching, and I hope to see you in the next one. Bye.